Hey, thanks for joining us, Steve Barsh from Dreamit Ventures on another episode and show of Dreamit Live. Today we're joined by Michael B. Tannenbaum from Brex, and we're streaming live right now from New York City from Brex's offices. Thanks for hosting us here today. And we're going to be talking with Michael today about how Brex has raised nearly $600 million in the last 3 years, lessons learned from Brex, SoFi, all the different organizations you've been involved with. As you're joining us, by the way, when you come in the comment section, whatever platform you're on, you might be on LinkedIn or YouTube or Twitter or Facebook. In the comment section, please list what city you're coming in from and what company you're part of. We'd love to know. As you hear our comments today in our discussion, we're going to go for about 30 to 35 minutes. If you strongly agree or disagree, put it in the comments. If you have a question for us, put it in the comments, and we'll queue up those questions and we'll take them at the end of the episode today. So we're going to chat for a while. Last thing, if you have ideas for future guests or topics you'd love to see us hit on Dreamit Live, please put it in the comments. If that guest or topic gets hit, we'll make sure to give you a shout out. Let's get started. Michael, welcome. Thank you for joining us today.
Thank you for having me.
Can you first give us a little bit of background on yourself? Who are you? What have you done? Where have you been?
Sure. So, I'm originally from Boston.
Okay.
And
what area in Boston?
I'm from a town called Wellesley.
Okay. Yeah.
And I actually took some classes in high school at Wellesley College, which is unusual because it's an all-girls college.
Right. Okay.
We can get into that, but
okay.
It's probably not worth it.
Okay.
We'll leave that one alone. But then I started my career in Wall Street, and then I worked in a private equity company in California, and then I went to a company called SoFi that you referenced.
Right.
Started there pretty junior and kind of worked my way up through the finance department to take over the finance department, then the mortgage business there, and then I became chief revenue officer. Relatively young, I was 29.
Wow.
And then I joined Brex super early. Was before we were called something different, and we were in a.
Wait, what were you? What did
we
you?
were called Vyond, Veyond.
All right.
It's kind of hard to pronounce and spell, which is one of the problems.
Right.
And it also sounds like meat in French.
Okay.
So, and I joined the company really as the first, you could say, American employee. It was two Brazilian founders and another Brazilian woman and me.
How's your Portuguese?
So I've learned a lot of Portuguese, but not a lot of it's appropriate.
Got it.
But I like Portuguese. My favorite
cool language.
My favorite phrase in Portuguese, which is safe for work, is "tamo junto," which means we are together.
Okay. All right.
Nice phrase.
That's nice.
Yeah.
So wait, so you did SoFi, Brex, and then what's your role at Brex today?
So
how long have you been here?
I'm the CFO. I've been here for about 2.5 years, which is the company's actually only been launched for 18 months.
Right.
So I've been here. Through the launch, I ran the launch. I was the kind of the guy running it.
Right.
And today, as CFO, I manage finance, operations. And which includes credit and capital markets and things that you associate with finance.
So and you've done finance at SoFi. You're doing finance here. You're CFO here. I'm just curious, where did you go to school? And what's your degree in? But by the way, I'm a big fan. I say to our kids all the time, what you learn in school is how to learn. And once you learn how to learn, you can learn anything.
Yeah.
So I'm curious, what did you?
So I went to Columbia in New York City.
Wait, you did not go to Barnard? Because
no, I stopped the all-girls school.
Okay, got it.
I actually received a complaint I was too participatory in class. I wasn't mature enough to know that even if I knew the answer at the time, given I was the only boy, maybe it was best to shut up.
Got it.
So
you went to Columbia?
I got a call from that professor.
Right.
But yes, I went to Columbia and I studied economics and urban studies, which is like city growth and planning, which has not too much to do with what I do today.
Right. Okay. No, it's fine. It's cool. So you're at Brex today. For those that are watching,
so far, unless I'm terminated by the end of this.
No. This will be good. Be good. So you're Brex today. For those people that are watching, what's Brex? What do you guys do? What's the story? Where did it start?
Yeah, so we're a payments company. We build financial services for growing companies. And so what that means is, at least initially, we started with a corporate credit card that focused on early stage startups, which we were ourselves. So it was kind of interesting building a product for ourselves.
Oh, that's cool. Then eat your own dog food.
Yes, exactly. And then we expanded to other fast-growing companies like life sciences and e-commerce businesses. And then most recently, we added a product called Brex Cash, which is a corporate cash management account, replaces a bank account and allows you to make payments not just through a credit card, but also through ACH, wire, bill pay, check.
Right. Okay. So what makes you guys unique and different? And let me give you the thought there, right? So I live in Philly full time. I've done a lot of startups, a lot of LLCs and small companies. You go to TD Bank and they're like, sure, Steve, here, sign here, and you can get a credit card that $5,000 line of credit. Oh,
right.
That's terrific. What makes you guys different?
Yeah. So I think what's different is that across the dynamics of underwriting, payment terms, rewards, and product experience, what we do is specifically tailored to the customers that we serve. So
that focus is?
Right, and that focus is, for example, in the tech space, we underwrite based on bank account rather than underwrite based on the consumer. And so because of that, because traditionally in banking, there's a problem of how do you underwrite an early stage company? It doesn't have any history. So what we do is we use the bank account balance and history, which every company that works with us has, and then we're able to underwrite, which is really beneficial, rather than have to personally guarantee the card or underwrite and give, as you referenced, a consumer-like limit. We give a business-like limit because we see all the cash.
Because you're looking at the balance sheet, right?
Yeah.
Okay.
And then on top of that, we built expense management features like receipt capture and integrations with accounting software, and we built a rewards program, all of which are very highly customized to this tech vertical or e-commerce vertical. And so it's vertical specific features and products that add a lot of value and allow us to compete with, say, TD, who has a branch on every corner.
Got it. So,
at least around here.
So I'll tell you a couple things. By the way, we're a customer. Dreamit Ventures has a Breck card. We've had it. I remember when I read about you guys launching out of YC and stuff, I was like, this is awesome. This is a great idea. I left it on our controller's desk. I was like, you might want to take a look into this. And I said this to Brittany and Darren at Dreamit. And a couple weeks later, I noticed a black card sitting on her desk.
Nice.
She's like, oh, this is awesome. This is terrific.
There's it's now orange.
It's now orange.
Yeah.
Okay. Wait, if you're going to take it out,
no, I won't take it out. Maybe it's best for privacy.
It's for privacy, exactly. Yes. So the way I think of it too, and because we have a bunch of startups, like it's a perk for Dreamit. A lot of accelerators like Dreamit, YC, Mass Challenge, a lot of Techstars probably has it too. I know you guys are really focused on startups. And the way I've always thought about what you guys do, it's a little bit like, cool, when that wire transfer comes in from your VC firm, the next thing you do is you get on the Brex website and grab your Brex card because it's going to attach where, again, TD is going to say, great, here's your credit card for $5,000. That's kind of when I think about it, right? It's that startup or early stage life sciences, biotech, whatever it may be. But if you're that growing startup, that's kind of your sweet spot?
Yeah, that's definitely our sweet spot. I think we're hitting on an interesting point because when we were launching, I actually ran our marketing, and one of the biggest problems we had was what is the moment in time in the life cycle of a startup where you need a corporate credit card? It's actually not that clear. Right. It's not clear, but what is super clear is when do you need a bank account, which is before you start anything. And so that's why we did Brex Cash.
Right.
So with Brex Cash, that first wire into your VC, from your VC is actually into the Brex Cash account, and then it comes directly with the card. So that's really powerful.
And Brex Cash is like one of the high yield savings kind of thing, but targeted at corporate.
That's right. Okay. That's right. Similar.
Okay. Pays a similar rate back to my TD example? Just kidding.
Yeah. No, so I believe Brex Cash is among the highest rates in the market, if not the highest.
Yeah. It's awesome. Okay. So you've been here about 2.5 years. SoFi before that. So for the rest of this episode, a couple things I want to get into. Again, if you're just joining us, pop into the comments where you're from, what company you're from. If you have questions as we go through this, if you agree or disagree, pop it in the comments and we'll curate all of that in about 20, 30 minutes, we'll come back. So for the rest of this episode, the thing I want to do, let's talk a little bit about SoFi. We'll focus most of the time on Brex.
Sure.
I want to talk a lot about lessons learned. I think we get a lot of founders and entrepreneurs from around the world watch this. I'd love to hear from, you've been involved with 2 unicorns now. You've raised a lot of funding. I want to talk about lessons learned. I want to talk about if you could, rewind the clock, what would you have told your younger self? You're not that old, but you were definitely younger. So let's get into that. So first of all,
age is relative because our founders are 23.
Okay, there you go. Very cool. So let's first SoFi. So for people who don't watch, Dustin, who's producing today, and thank you, Dustin. I know his wife just refinanced with SoFi.
Love it.
What's SoFi? Just real quick so we can talk about that.
So SoFi is an online lender that started in the student loan refinancing space and then built a suite of financial services targeted towards early career professionals. And so mortgage, personal loan, credit card, that kind of thing. But all consumer, very millennial focused, very big brand.
Okay.
So I think SoFi's done a great job building a brand.
So social finance, right?
Yeah, social fund. It was actually a .org when I started, which freaked me out a bit, but yes.
That could freak you out. Yeah, it's tough to go pitch a VC firm like, no, we're not social capital.
Right, exactly.
.org. Michael at SoFi.org.
Exactly.
So, so you went through that. How long were you there? What was the growth like? What was the fundraising trajectory at SoFi?
So I got there and we had raised, I think we were about Series C.
Okay.
And when I got there, I was about employee number 75. And then quickly, within 6 months, I was working with the CEO to lead our unicorn round when we became a unicorn there. Right. And that was a very exciting round. We did, that was the first round we had real professional, or not professional, we had sort of more name brand investors, or more well-known outside of VC in Silicon Valley. And then after that, I actually did a SoftBank round, which was $1 billion of capital raised. It was the largest, it probably still is the largest FinTech round, maybe in the US.
Billion raised, not
actually
valuation.
Billion raised.
Billion
raised. So big, I mean, we were a lender, so it was more balance sheet intensive. So that was very exciting at the time. It was pre-Vision Fund. And I was, so that was sort of my 2 big rounds that I worked on there.
By the way, I'm trying to do the math in my head. If Brex cash existed back then and I had it at a 1.6% savings rate on $1 billion, oh my God.
Yeah, you'd be pretty good.
That kicks off some interest.
Oh, it definitely does.
Okay, so raised $1 billion. So when you left, you were there. So what was the total raise and what was the valuation,
So we raised, so we probably raised basically at a 2.5-ish pre and raised $1 billion on that. So we gave away almost a third of the company.
Didn't give away, sold.
We sold almost a third of the company, however you want to phrase it.
That's fine. Okay, cool. And then you worked with the CEO on fundraising, all of that, right?
I did,
CFO.
yeah. So I was not the CFO, I was the VP of Finance, but I was sort of, and actually we have that same structure here. I myself, until the end of a fundraise, don't typically work with our CEO as much.
Right.
I don't spend a ton of time fundraising in the beginning. I let the CEO sell
out there pitching.
Yeah, pitch and sort of sell the dream.
All right.
And then I kind of come in and be more of the tough guy role when it comes time to actually close.
Got it. Okay, let's come back to that. So let's Brex. So been here for 2.5 years. Your employee number, what's your badge?
I'm technically number 1.
Okay, number 1.
Because the person that was first hired was from Brazil and visa had not cleared yet, was still on a student visa, so wasn't able to be on the payroll yet.
Wow, that's very cool. It's funny, I have a good friend, David at Google, and he has probably a similar email address to you. It's david@google.com, right?
So I'm Michael at Brex.
Michael@brex.com. It's good when you're the first name. It's always a good sign. So you're employee number 1. How many people? So let's just talk about growth.
Yeah.
And again, we'll get into fundraising, but fundraising fuels growth. So when you got here, I know how many people there were, like a handful.
4, yeah.
4. So it's 2.5 years later. How many people are you guys today?
We're about 400.
400. Okay, that's a big.
It's a big jump.
Growth.
Totally.
Are they all? We're in New York today. Where is everybody?
So we've got 4 offices. One is here. Our headquarters is in San Francisco. That's where I started. I recently moved here.
Right.
And then we also are in Vancouver and Salt Lake City.
Cool. Salt Lake City. I bet you a lot of people want to go there. Sundance Film Festival is going on in Park City right now. Everybody's like suddenly expense reports.
I was there yesterday, although I did not make it to Sundance.
I'm sorry. Next time you're out there, we know a lot about Park City and Deer Valley. Take me up on it. I'd love to host you. Anyway, so you're 400 people today. So we're going to get into fundraising, but again, it fuels growth. So you're 400 people today. If you look out a year from now, 18 months from now, how many people do you think are going to be here?
Yeah, I mean, I'm always hesitant to measure growth and success in terms of headcount. When people say oh wow, you have 400 people, it's like all we do is pay them, right? Hiring a bunch of people doesn't mean they're successful or doing what you want. So I try not to measure it in headcount, but I would say that I would probably expect us to be maybe somewhere 700, 750 in a year.
Okay.
So I would say slowing down a bit, just as I think Brex has done a great job of hiring in advance. So we've always had things like we had a sales team before we needed it. We do a lot of, we've always planned on being a big company and operated in the sense that we invest in things, systems, people, processes early, even before it's necessary.
Okay, so if you're going to grow nearly 100%, nearly double, just could you give us an idea? Again, it's important, and it's going to back into the financials if people are watching, like, why is he getting into all this? I want to hear about raising, but you raise around a lot of different things. what are the big buckets of people? Are they customer service? Are they sales? Are they development? Like, what are the big buckets?
So like broadly, half the company you could call it would be EPD, engineering, product, and design, and then go-to-market function would be probably another 30%, which would be sales, marketing, customer service, and business development, and then the last would be sort of finance, ops, HR.
Got it. Okay.
Which some people call G&A, although I do not like that term.
No. Yeah, SG&A or G&A. Got it. Okay, so
I don't like to be known as as your P&L line item.
Got it.
Sure.
Yeah, exactly. So you open yourself up to a question. Like you said, I don't want to measure myself. I don't think we should measure ourselves. On the number of people that work here.
Correct.
So what are the KPIs? Like, what do you, and you don't have to get into detail, but what's important?
I think that definitely, obviously, top line super important. So just revenue. For some people, users is sort of
or customers.
Customers for us, it would be kind of volume, and then revenue is a derivative of that. Like payment volume, just number dollars of transactions going through the card, and dollars of cash invested in Brex Cash.
Right.
Those would be kind of, and then I think
is Brex Cash always still in beta? I know I actually tried to get something in. It's not
still in beta.
Okay. All right.
Beta will be ending beta later this season.
Right.
And I think that we will, and then as you get more mature, some sort of profitability at a minimum, unit economic based metrics are important as well.
And we're going to come to that. Yeah. No. Absolutely important. So. A lot of growth behind you, a lot of growth in front of you. How much have you raised to fuel that growth? Could you break it down a little bit, maybe some rounds, numbers, and valuation?
Sure. We've raised about $300 and a little over $315 million of equity.
Okay.
And at this point, another $300-ish million of debt.
Okay.
And so Brex's debt is different than is applicable for all companies,
right?
Because because we're a lender, even though it's very short term, we accumulate assets on our balance sheet that then we can leverage.
Got it.
And so it's actually more natural for us to have debt.
So you're not talking, when you talk about debt, and we're going to get into this later, because I think there's a lot of entrepreneurs and startups we talk to at Dreamit. We operate, that seed Series A, and they don't understand venture debt.
Right.
And they don't understand the difference between debt and equity. There's that side of it, but are you talking more about line of credit type debt at LLC, not like venture debt? Or
that's right.
Both?
I mean, so we have done venture debt here as well.
Yeah, which I want to get into, because I think a lot of people don't understand.
Yeah, I mean, I think the main thing to understand with debt versus equity is that the sale is different, because in equity, it's all about the upside.
Right.
And in debt, it's the opposite. The best you can get in debt is paid back.
Right.
Maybe there's some sort of warrants or convertible thing that has a little bit of a sweetener, as they say. But the reality of debt is all you can do is get paid back. So people aren't so much, for example, in our debt rounds, it will be me leading rather than the CEO, because it's not about, there's a little bit of they want the vision. Maybe the company wants to know that there'll be an IPO someday so they can get their bankers paid, et cetera. But it's really about, am I going to get paid back?
It's interesting, when you're looking at that type of debt, are you actually thinking about way down, at an IPO, like who do you want to partner with for the debt? Because eventually, or they're trying to
I think
swoon you for debt?
That is, depending on who's giving you the debt. If you're doing a Wall Street round, then definitely. So for us, in our case, we have debt from both Barclays and Credit Suisse, and I am confident that the future fees on capital markets transactions from Brex are relevant in their decision about whether or not to pursue.
Got it. Okay. Interesting.
And if you look, as companies start to go public, it's a very common step that you'll see is they do a credit facility and sort of pick their bankers and ask people to lend to them. Right. So.
Okay. So you've raised a little over $600 million between debt and equity, or their line of credit, however you want to phrase that. What's your valuation? Can you say this? I know it's public.
It's public. It's $2.6 billion.
$2.6 billion.
Which sounds good. That's a big number.
It is. It's a big number. Can you talk about? You said as part of your fundraising experience, you talked and really nicely, like, hey, look, the CEO is out there selling the vision, or you have co-CEOs, right? And then on the debt side, it's really more you, because it's strongly a finance function, but. Maybe on the equity side, could you talk a little bit about how have you worked with the key co-CEOs on fundraising? How does that work?
Yeah, and so I wouldn't be so prescriptive to say that everybody should do our model. Yeah. I think it has to do with who your CEO is and who your CFO is. Oh. But I think that in the beginning, people, particularly in venture, they're investing in the primary question they're asking is, can this be really big?
Yeah.
And is this worth? Because in order for the venture economics to work, they need some unicorns.
Yeah, absolutely.
And so that's where somebody who is very growth-oriented, very visionary is going to do best.
Got it.
Typically, that is the CEO.
Right.
It may not be in some companies, and then it is incumbent upon the CFO to either be that person or find that person who can help do it.
So, but when you have two co-founders, right? Two co-CEOs, Brazilian. I would assume if they're pitching anyone that, by the way, speaks Portuguese, they get to lead all of those discussions.
Yes,
right?
That's right.
Portuguese is much better.
Yes.
But when you're in the room, like, are you in there and in some of those early pitches, or when are you getting involved?
Yeah, my thought on fundraising is that it's like any relationship, and so you don't want to. Typically, the best relationships don't start where you need something right away.
Right.
So if a lot of the work is done by the CEO in advance, who has met with investors, talked to them about what we're doing before you're raising money, so then when you come, it's not like, hi, how are you? I'd like money now.
Right.
And so that's a bit transactional. And so I think in the case for my role, I would not be there in the beginning. And this is something that we talked about before we went on air, but my opinion is that good companies don't spend that much time fundraising. You got to be running the business. So my fundraising always irks me in some ways because I just want to get back to doing what I do, and it's sort of a distraction.
It is.
So we try to, and it can also be quite a distraction internally as employees.
What's
hear
going
about
on,
it, what's going on.
What's our valuation?
Right.
What are my stock options?
Exactly. So I think that one of the things we try to do is have a lot of that done by the CEO, and then when it's real, it's time for me to come in.
Got it. So when let's think back, SoFi, Breck. SoFi, you closed $1 billion in financing at SoFi, not valuation, cash in. Here you've done $600 million. When the level and where you're operating today, and again, if you're just joining us, Brex is a great unicorn, high-flying startup. We're a customer. A lot of Dreamit startups are customers. A lot of other accelerators. It's that primary target. Our early-stage startups, e-commerce, biotech. When you guys walk out, or when your co-CEOs walk out and you're on Sand Hill Road or you're in New York, do you just walk out and for you, just the check clears the bank, wire transfer comes in, it's almost like an ATM machine? Or, the question behind my question is, we talk to entrepreneurs and startups all the time that are going through Dreamit, like, look, it's a roller coaster.
Right.
And it looks all great in the headlines, and there's this great TechCrunch headline, everybody's like, God, everybody's got it so easy. For you guys, is it just like, there's no questions, people just write a check, or are there ups and downs that you can talk about?
No, there's definitely ups and downs. I think there's, the best breakout unicorns always have that phase where it does sort of feel ATM-like.
Yeah.
And I've definitely been at both companies through rounds where you're feeling like everybody wants to play ball, and you've got all these term sheets, and you're just deciding, and it's so exciting. And that's going to be the case for good companies sometimes, and then markets will change. Things like this fall happen where investors get more conservative. Actually, winter of 2016 started off super rocky for online lenders at the time for SoFi. Very rough. Lending Club had big problems. So that was. I've definitely gone through ups and downs, and so I would say that a good financial planning is to make sure that you have that buffer. Because at least in post-global financial crisis, we haven't seen consistent periods of long-term disruption.
Right.
There will be those in the future, but at a minimum, what we know that there are going to be some of those minor fluctuations, and it's important that you can always ride those out and not be raising in a time when whatever you're selling is what people don't want.
And do you think that's the classic, if people offer you cash, take it, because you never know?
I tend to agree with that philosophy, actually. That would be my personal advice. If someone's there, I would say take it, especially until you are if you're not dependent on venture money because you're now self-sustaining, then no, that's no longer true. Okay. But otherwise, yes.
So I wanted to ask it later, but the timing seems really good for now. You said, the things come in waves. In 2016, you've raised money from SoftBank. Do you think what happened with WeWork and SoftBank and that kind of debacle and what's going on with that, do you think that's going to temper what's happening for unicorns and people doing really large rounds?
Yeah, I thought, so it definitely had a tempering effect in the fall. You could feel a chilling. I think that 2 weeks ago when Visa bought Plaid, especially in the fintech space.
And can you remind people how big was that transaction?
That was about $5.2 billion.
Right. With a B.
With
right?
a B.
Yeah.
So, and I think a company like Visa.
By the way, Brex starts with a B. You know?
Breck starts with a B.
Right.
Yeah, I like B's. I do.
Yeah.
But no,
wait, that's why it's Michael B. Tannenbaum.
Yes.
Okay.
Middle.
Okay, I got it.
Yes, exactly.
Got it.
So
Okay.
you're actually one of the first people to ever really refer to me as Michael B. Tannenbaum.
That's what your LinkedIn says.
I appreciate it.
Anyway.
It's accurate.
Sorry, got off the track. WeWork, SoftBank, tempering effect on
Yeah,
financing
I think that,
at this scale?
but so because Visa is such a well-respected company and so well-known and not known to be a fool, them paying $5 billion for a kind of high-flying fintech company at a premium from their last round, I think feels really good to the market. So I think that my opinion on the SoftBank sort of fallout that you saw was actually much more about the asset management industry and just the idea that when you raise such a big fund like Vision Fund, you have to put that money to work, which sort of by its nature inflates valuation. And then it also means that because you're putting so much money to work, you have to basically band together 6 other VCs to match that. It made people who took money from SoftBank, it made it harder to get money from anyone besides SoftBank. And so I think it's sort of, it wasn't really, it was almost just it was set up to be this way because of how big the fund was relative to other fund sizes.
Okay, so I want to go back. So thank you for your comments on that. And if you're just joining us, it's Michael B. Tannenbaum from Brex, and we're streaming live from New York today from Brex's office. Thanks again for having us. I wanted to go back. We were talking a little bit and some of your experiences about raising venture capital and equity versus venture debt.
Yeah.
Do you have any thoughts based on your experiences, 2 big companies? Like when should a startup be thinking, no, go for venture debt? And again, that's different than we have Dreamit companies that do all kinds of financings and large lines of credit. It's more on the venture debt side. I think is interesting because I think a lot of people don't understand it.
Yeah, I think venture debt is best used to plug short-term cash needs in advance of milestones that will have big fundraising impacts. So for example, if you're waiting for a public launch of something and you need a little bit more money to get there, or maybe even a lot more money to get there, but you know that your valuation is going to be meaningfully different once you get there, venture debt is a good way to minimize dilution and help you get to where you need to go. So that's the way that I would typically use it most. The other way is that sometimes when you're raising a round and you need a certain amount of proceeds, right at that time as you're marking up your valuation, hopefully, is a good time to raise venture debt because you have a new money, fresh money coming in at that value, which gets a lender more comfortable.
So there's a couple things you said, though. Let's drill a little deeper, and I want to unpack. The way you just described venture debt, you made it sound like a bridge round. Right? Oh, I need a little more time, a little more runway.
It can be. That's one of the ways.
Right? Because again, like we see not Dreamit companies. I mean, sometimes, but you see companies. Well, I raised my Series A, but I'm doing a bridge round of the Series B. And by the way, like we say to people all the time, great. It's a bridge to where? Is it a bridge, or are you walking off the end of a dock into the water? Right. It's got to be a bridge to somewhere.
Right. So I'm sorry. No, so I think it should be like you clearly have this milestone that is that you have confidence, right? Because debt is about confidence to be paid back. That you have visibility into something that is going to materially change the status quo.
Right.
And you need money to get there, and you don't necessarily want to raise equity in advance of that. Typically, venture debt comes with covenants, or always.
Yep, absolutely.
And so venture debt is never going to be your last dollar because they'll make sure they're paid back before they are.
So it's not
it's not for last dollar. It's for I'm not quite ready to raise, I want a little more cushion type thing, or it's for I'm raising a big new round and maybe my lead investor is there at a good value, but they're not, for whatever reason, they're not putting in as much as I'd like to raise. And maybe venture debt is a nice way to bridge that and add more gross proceeds to the round without adding dilution and or without having to get another counterparty.
Yeah, and that to me is the biggest thing I always think about. It's the dilution, right? If you can get debt and not sell pieces of the company, you're not selling 20% of your company for whatever valuation,
right?
That's great. I mean, it's better to hold on if you can get the cash that you need. So
yeah, and it's a little bit like personal finance, right? There's going to be people, like I talk to people all the time because I'm the CFO. People always ask me for personal financial advice, and you're not really supposed to give it, but sometimes I do. And people will, there's some people who are like me and have mortgages, and they only do interest only because they think blah, blah, blah. And then there's people who are like, no, I'm a 30-year fixed kind of guy.
Right.
And I'm not a 30-year fixed guy. You can probably just tell talking to me.
Yeah.
But that doesn't mean that it's not a right product for some people. So it's a little bit about the founder and the CFO and the management team's risk tolerance as well, and how much they want to lever the company.
Okay. So as we keep going here, if we can go about another 10 minutes or so, a lot of questions for you. I think one of the things, an interesting thing, you probably didn't see it earlier this week, I did a little LinkedIn live thing, and what I was talking about was, to so many founders, stop raising and start selling. We see so many entrepreneurs, all they're doing is raising. I was like, screw that. You should be out, if you spent half the time that you spend talking to investors actually talking to customers, you have to raise less, and they just don't have enough traction to get to the milestone. My point with that, so it's kind of interesting, this is the opposite, from that to a unicorn and hundreds of millions that you're raising. But I want to talk about, and I think it's really important for entrepreneurs to understand, that when you're raising rounds like this, there are downsides to it. Right, you're eliminating optionality. You're eliminating possibilities. If you could talk about it? Because I think people don't talk about this, so we should. What are the downsides when you're raising like this?
Yeah, I mean, so the first most obvious one is just management time and distraction.
Sure. Absolutely.
So I think that's one of the reasons why you want to raise a certain amount to get to where you want to be in a certain future milestone, rather than always be raising, because it's just going to distract you.
Right.
And actually, investors will tire of you as well.
Right.
I think number two would be that there's this implicit sense among people that work within technology that private valuations need to go up every round.
Right.
And so as you raise, you need to be careful about the internal signaling mainly of having a down round, which is quite different than working at even the best performing companies, that even the big tech companies, their stocks drop from on a quarter, but it doesn't mean that people start leaving. Right. But I think internally there's a lot of concern in a private company if the stock price goes down.
Okay. The other thing though that I've seen, and a really good friend, I don't know if you know Josh Koppelman from First Round Capital, great VC, really good friend. He has a great way of expressing this. As you raise more money, right, optionality closes down on you.
It does.
Less options are on the table. He has a great analogy. Dustin and I took Amtrak from Philly today up here to New York City, and a great analogy I remember that Josh said. I can get from Philadelphia to New York City a couple different ways. I could take SEPTA to Trenton and then take the New Jersey Transit or whatever, and it's much, much cheaper. It's just a little bit of cash. And there are 20 stops along the way. It'll take a lot longer to get here, and there's 20 stops along the way for me to get off. Or I can take the Excella, and I'm going to pay 10 times the price and need 10 times the cash, and I'm going to New York City, and there's no exit along the way. And I think one of the things is, like when you talked about the big acquisition that happened in FinTech a few weeks ago, right? When you're raising cash like this, like we were talking about, when you're in the beginning in Brex and you haven't raised much, right? There's 1,000 companies that could buy you, and then you raise 100 million, and now there's 500 companies that could buy you. And I think that's important for entrepreneurs to understand. As you raise more, there's less optionality.
Right, and there's always going to be entrepreneurs that just are not interested in selling and don't care.
Sure. Okay.
But so there's just a segment of the market that's not interested. But I think if you are interested, which is the majority of the market, I think it's a pretty important point. And there's, especially in FinTech, where we have been, there's sort of something talked about, this FinTech trap, which is once you get over $1 billion, particularly in financial companies and valuation, because banks are more goodwill sensitive in the sense that when you buy a company for more than the book value, you create goodwill.
Sure, absolutely.
But for banks, the capital rate, it impacts capital ratios, so they're not as able to pay these huge prices. And so because of that, you sort of trap yourself, and you may not be a target for many people, so you have to go public, and then you need to start to think, well, does this company make sense as a public company? Because a lot of times niche market, niche vertical stuff, it's kind of a confusing story for the public market, and it's not a natural fit for an IPO. And then those companies sometimes get trapped.
Right, got it. Interesting. Okay.
That sort of happened to a lot of online lenders.
Yeah, no, right, yeah. Some tough stories along the way. So let's go back to Brex, right? Well, we're on Brex. So you've raised about 6 or 7 rounds, how much?
So we've raised 4 equity rounds and 2 debt rounds.
Okay, so 6 in total, but 4 equities, 2 debt. So again, Dreamit, we operate a lot in seed, Series A, a lot of Series A rounds that we do, 3 different verticals we work in.
Yeah.
But what's interesting is I talk to a lot of entrepreneurs and they're like, well, I'm thinking about my valuation. I was like, well, I can tell you what your valuation is. It's pretty much a ratio and a math formula.
Right.
You're selling 20%. So if you tell me you're raising $1 million, I'm telling you that your pre is 4, your post is 5. And it's programmatic. And they don't understand that. And we often tell entrepreneurs when they're early stage, give a range. We're raising 1 to 2 million because you're signaling what your valuation should be. Okay. With that said, you're doing B, C, D rounds, debt rounds. How do you figure out valuation? Where, you know?
Yeah, so I think it has to do with as you get bigger.
And by the way, is it you and the co-CEOs, here's our valuation, we're doing our D round, or is it investors coming back to you?
It's more, so what you're doing is you're looking at, as you get bigger, you're raising from different people, right? So you're kind of people that are playing a different game. So it's important to understand what game they're playing. And they may be kind of growth stage VC targeting 5 to 10x. They could be crossover people that are looking for an IPO, and maybe they're targeting 3 to 4, right? And so it could be private equity that just targets basically 3.
Right.
And so it depends on kind of where you are and what the expectations are, and so you can sort of look into the future of your projections, see what you could be worth in a reasonable scenario, haircut it perhaps, look at some scenarios, and then say, okay, well, in order for us to get there, what does my investor need to make back, and then sort of back into it.
And you just back into it, reverse engineer. If they need a 3x, what does it need to look like?
Right.
And will you actually, as a CFO, will you sit there and go through calculations like that with them?
I think that in a really healthy, robust round, you would not. Right? It would be obvious to them that was the case, and you might do your homework. But I think as soon as you are starting to talk about what your value ought to be to a counterparty, you've lost a little bit of momentum already.
Got it.
Doesn't mean that it won't happen. It will inevitably happen. It's happened to me before. But I find once you're trying to tell people like how it's going to be versus them deciding, you're definitely not in as strong of a position of power. Same with an M&A, right? If you're trying to like justify what the synergies are going to be, that's usually, it doesn't mean it won't happen, but you're not in as strong a position.
So I want to talk about, and we see a lot of early stage entrepreneurs obsess about valuation. When you're doing these deals, and the deals, you've probably been involved in 10 financing rounds total in your career in the last 6 years?
I did a bunch of debt at SoFi also.
How much total have you raised over that period?
I think if you count debt rounds, et cetera, probably around maybe $4 billion.
$4 billion. Wow, that's a lot. And if it was in a Brex cash account earning 1.6%. Okay.
Yes.
Anyway,
that'd be good.
So, when a term sheet comes over the transom, so you get an email with a PDF attached, and here's the term sheet. Is the only thing you're looking at valuation? Like, what are some of the things everybody gets excited? Your co-CEOs get excited. You're like, okay, whoa, guys. There's some other things. What are the two or three things that you're looking at?
So governance, particularly for founders, is usually a big deal. So voting, board seat, limitations on the company's ability to raise or sell in the future at certain prices, any kind of what they call structure, so things like ratchets, or things where anti-dilution, all of those sort of governance is important. And then I would also say that the person itself, who the person is and whether you like him or her is relevant.
Okay.
And I think that...
The classic, you're getting married for a while.
Right, at that, and then also, at least in competitive fundraising, what that firm or fund can do for you, right? And it doesn't always have to be what actions, but what messaging does it send to the market, right? From a strategic, for example, if we had raised an investment from somebody like American Express, which we have not, of course, but that would send a very different message than us raising from, say somebody like Facebook.
Got it.
Right, so that kind of thing.
But if American Express is watching, right? It's Michael at brex.com. No.
Yes. Sure.
Okay.
Yes.
So, okay.
I'll meet you outside.
There you go. I'll meet you outside. We'll give you the address in New York City. So there's one other thing in the term sheet I want to ask about. What about things like stock options and that shell game? And again, there's so many, everything it's just valuation. It's
right. So, options, a lot of times actually the option pool will be negotiated by, the investor is usually advocating for a larger option pool prior to them putting money in, because they don't want to take that dilution.
Right. Correct.
So that's always one of the sticking points is, whether or not the new investor takes the option dilution. So that's definitely that's more of a valuation point.
If for people that are watching, by the way, if they don't know all of this and it's not just reading online, who do you turn to for help? Do you talk to other finance people, attorneys that you work with? You're like, help me think this through.
I mean, I kind of figured it out on the fly.
Yep.
I never really had anyone to, I guess, attorneys are good sources.
Can you say who you work with?
I worked with Oric at SoFi. We worked with Wilson Sonsini at Brex. Those are two very blue chip. You don't need to do that necessarily.
Right. And by the way, I'm a big fan. Although there's a branding to it, right? I always like to say I hire attorneys and accountants, not law firms and accounting firms.
Right.
It's like, who's the person I'm working with?
Yes. Well, so the one was named Peter Cohn and one was named Damian Weiss.
Cool. We love shout-outs.
And then I think I think to learn, my biggest advice is just reading the docs.
Right.
Like that was always a competitive advantage. It was taught to me at SoFi of at least one time, you should read the stockholders purchase agreement.
SPA, yeah.
Right. You should read the investor rights agreement.
Right.
Like these are things that if you've never read them once, and you're a CFO, like that's a problem.
A couple startups I've done where I've been CEO, I've read those docs, and it's funny because you're like a couple times like, I'm just going to huff through it. It's going to be a weekend, and I'm going to go through all of them. You go through all of them, you hand it back like with a couple questions, spelling mistakes, typos. Are like, oh my God, nobody reads this stuff.
Yeah,
it's like I got to read it because I really.
It's
need to
important
understand
though. Yeah, I read it.
Yeah, that
at least the first time you got to read it.
So let's kind of. I want to start getting towards wrap up a little bit. So you think of SoFi, you think of Brex. What are the top 2 or 3 lessons you've learned in all of this? Maybe 1 or 2 things that stick out, biggest tricks or biggest traps.
I think until you really know what you're doing, you need a mentor.
Okay.
So you may know what you're doing right away. You may not, but you do kind of need someone looking out for you in the world of startups. I think because it's not like in traditional businesses where there's natural hierarchy and progression and people are invested and that's just the way it is.
So can you turn to, so you guys went through YC, can you turn to your accelerator like a YC or Dreamit Ventures or Techstars? Can you turn to your attorney? Who's that mentor?
It can be someone internally.
Yep.
Depending on how junior you are. I think if you're the one in charge, then it's probably not going to be internally.
Right.
So you've got to find either another founder or another more experienced CFO or I think absolutely you can go to somebody as an accelerator. They do serve that purpose, and we did in many ways. During especially for me running, so I had done finance before. I thought I knew what I was doing, but in a marketing role, I was turning a lot to our accelerators to get information.
Cool. Okay, so those are a couple things that you've learned. One other thing I wanted to ask, so for the startups and founders that are watching, that hopefully will get a Brex card when they get that wire transfer, it's great.
Yeah.
So what are the processes that they should have in place and for an efficient fundraising process to make sure it goes smoothly? Because we've seen startups, not Dreamit startups, because it's a well-oiled machine right now, but like they almost snap defeat from the jaws of victory when they're going through financing. Right?
Yeah.
Got a term sheet and the whole thing falls apart.
Yeah, I think you need to have your financials in place ahead of time. So you should have some form of monthly financial process and close, so you have something. No one's going to invest in nothing.
Right.
So people are going to want to see income statement, balance sheet, and that you have some financial discipline.
But so to ask, are you guys modeling out 3 to 5 years?
So
and is anybody really grinding through?
It's not so much about like the actual numbers, it's just having something to look at and know what you're buying. Right. To know that the equity has been maintained and what ownership is actually real, how many shares there are. All that stuff needs to be kind of, it shouldn't scare people. I think modeling out 3 to 5 years in the early stage companies is excessive, but what I think is relevant to do, and it's something I talk a lot about, is to look at the public companies or companies in the market that exist that have some elements of what you have and make sure it makes sense. So if you're acquiring customers much more expensively than the public company out there, that's a problem. If your unit economics are way better, that's interesting, right? So you need to benchmark yourself to what's out there in the market.
Got it.
Market share wise, if you're saying you're going to get to a certain percent market share and Facebook is at half that, 17 years in, like you got to be worried.
It's interesting you mention that, by the way. When people see large scale acquisitions and they're in the billions, funny thing I always do is how many users or how many customers they have divided by the acquisition price. It's like, oh, look, they paid $50 a user.
Right.
Just because you were saying, like, what's your acquisition price versus the public market? And
right.
people don't, it's like simple math at a simple ratio. Okay, so almost wrapped up. You know, so for the last 6 years, you've been involved in these two big unicorns in raising. If you could rewind the clock and talk to yourself 6 years ago, what do you wish somebody had like tapped you on the shoulder and said, Michael, here are 2 or 3 things you should know, my friend?
Yeah, I think one of, at least what I've found is that there's oftentimes not a right answer or not a clear right answer at the time. And I think making a decision quickly is super important, and just being able to, like, in my opinion, being successful in the operating business, not as an investor, is a series of making lots of decisions, and you just have to get comfortable and move on, because people who hem and haw, that's the problem.
Right, okay. All right, cool, good. All right, Michael, appreciate it. We're gonna take some questions in a minute. Let me just, so we've been talking about Brex, we've been talking about SoFi. Let me hit a couple things real quick, and then I'm gonna open up for questions again. If people are just on, if you have questions, please put them in the comments. A couple things just about Dreamit, and then we'll hit questions. If you're interested in Dreamit, what we do, and ventures, Dreamit Ventures, and what we're doing in secure tech, health tech, urban tech, go to dreamit.com/apply. If you know of a great startup, send them our way. Those are the 3 verticals we work in. If you have ideas for future guests and show topics, please let us know. Just put it in the comment. We'll give you a shout out when that guest comes on. Other just quick content things. We have the Dreamit Dose. It's a really cool series. You might even like it. They're 5 to 7 minute segments on things that we see startups screw up all the time. Like, how do you think about the competition? They never get that right. What's your go-to-market strategy? Oh, I'm doing direct sales. That's not a go-to-market strategy. It's a sales strategy. So we do these things called Dreamit Dose. They're very intense. And
Got it.
YouTube. Dreamit Live episodes coming up February 5th. We have my partner, Andrew Ackerman, is going to interview from Camber Creek, the partner there. We have coming up, it's not even on our website yet, Laura Huang is at Harvard Business School. She does a lot. She studies and talks a lot about the intrinsics of when an entrepreneur is meeting with a VC and the signals a VC picks up and makes decisions on, I'm not investing in this entrepreneur. What are those signals? So it's a little bit, what's the hack that an entrepreneur needs to understand? Good friend and smart. And then later in February, Paul Martino, I don't know if you know Bullpen Capital, he's going to come on and talk about, he's financed Zynga, he did FanDuel. Paul just released a new movie, never did that before, but it's doing well. 5.9 on IMDb. Anyway, and we'll 5.9
out of what?
Out of 10 on IMDb.
Doesn't seem that high.
Yeah, it's not bad, but it's his first movie ever.
Okay,
it was really funny. It's called The Right, what's it called? I think I wrote it down here. Called, The Inside Game. Like his cousin or something was accused of something, the NBA got arrested. All these Paramount and stuff said, we're going to buy your rights. And Paul's like, you're getting screwed. I mean, how hard could it be to make a movie? And son of a bitch, he raised the financing and produced a movie. So
good.
It's
as
very
you mentioned, Sundance is this week. So.
And Sundance is this week, yeah. It's still going on. So a couple other things. If you want to catch Dreamit, we'll be at RSA in February. We'll be at MedCity Invest in Chicago in April. Let's take live questions.
Sure.
If you can stay with us an extra 10 minutes. Cool. All right, so first question we have. All right, so what do you look for in a lead investor, and how do you choose? We talked about term sheets, but are there any characteristics that you're looking for in your lead?
So there's obviously, one of the big things is your relationship with that person, and do you like them? But I think also is what are you feeling like you're lacking the most? Is it recruiting ability? Is it brand? Right? Maybe you've never done anything before, so it's super important to get a really incredible investor. Maybe you're actually a famous second-time, third-time entrepreneur, and you've already built this, but you want to expand into a specific area where you don't have domain knowledge.
Right.
So I think you should look inward and figure out what you don't have and what you're lacking, and try to get that from an investor.
And I guess that's and when you can be choosy. Like
when you can be choosy.
Yeah.
Well, if you're otherwise, you just look for someone who has money.
Right. Somebody who cut you a check. Right. Hopefully at reasonable terms. Okay. Cool. Let's go to our next question. Okay. So VCs say we bet on the jockey. So are these raises that are so high because of the jockey? I mean, these are huge numbers. I mean, are these just outsized jockeys, or is there more to it?
I actually don't even know. I don't understand the phrase.
Oh, I'm sorry. So a lot of times VCs will say, we don't bet on the horse, we bet on the jockey. We bet on the management team. You bet on the team, you don't bet on the business.
I'm not a horse racer.
Okay, all right.
So I'm from Massachusetts.
Okay.
So I'm not as familiar with the terms, but I think what you're asking is...
Well, there's a horse and there's a person that sits on it.
Yeah, okay. So I guess the question is it that entrepreneurs are doing a great job of selling? Yeah, I mean, I think that in the beginning, a lot of it is about the team because people pivot. And
a lot.
Just because people think they're doing, we pivoted, people think they're doing some stuff th're not. SoFi.
Can you talk about that pivot a little bit?
Yeah, I mean, I think when we started, we were going to be going after larger companies selling a lot of detailed expense management software, things that, and using the credit card as sort of a way
Got
in.
it. Interesting.
And then I think we realized that there was this big market of underserved market that had this hair on fire problem.
Oh, cool.
And it was much easier to grow faster. You know, the closer to consumer you get,
Right.
the faster
Absolutely.
it is,
Absolutely.
the closer. So it depends on just what kind of business you want to run.
That's cool. So you changed your target customer, you changed your value proposition. That's cool.
right.
Very cool. Okay, let's keep going. Next question. And again, if people have questions, just put them in the comments. We'll take them. So do you think all startups should be raising this level of funding?
I think that generally, I think raising funds is good. You don't want to raise more than you need, but you do want a buffer. I would say where it doesn't make sense is, as you kind of mentioned, if your sole focus is to fundraise to get a premium and valuation and just like you get some kind of thrill out of fundraising, then maybe you should be VC, right? Because like you're supposed to be an operator.
Right.
So, yeah.
Right. Okay. Cool. Next question. So you just said fundraising, it's a good thing. Cool, interesting question. Could either of these companies you've been involved with been bootstrapped? And why not, it says?
No, I think in FinTech, bootstrapping is hard if you're at all capital intensive.
Why?
One, just because as a FinTech company, having more capital means other people and customers want to work with you more. There's like this stability and sturdiness to it.
So it's a signal.
It's a signal. And then I think also they're just, I mean, it could have been bootstrapped by wealthy people, but not by us.
Right, okay.
So yeah, no.
Okay, all right, cool. And we're big believers. I mean, we have a lot of companies that come into Dreamit, they bootstrap all the way to their Series A.
I mean, God bless their heart. And it also has to do with how, starting a startup is very hard.
Right.
It sucks. It's painful.
Yeah,
it doesn't work often.
Yeah.
People are always questioning you. What are you doing? You feel dumb saying where you work because it's like, oh, I'm working at nothing.
Right.
And that's hard. And so the question is, bootstrapping is even harder.
Right.
So it just depends on how much pain do you want to endure.
Got it. Okay. Cool. Next question. Do you show, so we talked about this a little bit, do you show 3 to 5 years of financials? And how scrutinized are those models? So, VCs are like, I want to see your financials. Are they digging in and saying, wait, Michael, I don't understand, in cell XX52, how did you get that number?
I mean, kind of.
Oh, really?
I would say that in my experience, maybe because I'm very financial as a person, I have typically had always a 3 to 5 year model, even if it's high level and has assumptions. And I think people want to understand broadly the assumptions, but not so much cell by cell.
Got it. But it's that assumptions, because like what I've seen too is like people just want to understand the thought process.
Yep.
Just show us how it comes together. So, okay, cool. Next question from Ramesh Kumar, who asked it on LinkedIn. Ramesh, thanks for asking a question. Why would a startup use your credit card and cash management account with you rather than our current bank? Second question is around, do you do revenue-based financing?
Sure, I'll answer the second one first because it's easy.
Okay.
Yes, our e-commerce product is that way.
All right.
The
Revenue-based financing?
Revenue-based financing.
Can you just explain?
It just means rather than it based on, you're underwriting based on somebody's sales rather than underwriting based on their bank account.
Got it. Yep, okay.
And then a startup would use Brex because one, we're going to have rewards payment terms, meaning when you have to make your payment, and a user experience as well as receipt and basically expense management technology all in one. That's very modern and very tailored to a startup. Right. And so that's why they would use us.
Okay, and the other thing, and by the way, and Scott, who's here with us today, who helped set all this up, Scott from Brex, one of the cool, interesting things.
Bless his heart.
Bless his heart. But a side note, by the way, if you don't know, if you're a part of a major accelerator like Dreamit Ventures, YC, Techstars, Mass Challenge, all of that, I believe there's no fees for life.
That's right.
It's one of the perks
That's right.
for having the credit card. But my understanding, I'm just going to go back to my personal experience being a serial founder and serial entrepreneur, is like, you go to TD Bank and you get a $5,000 line of credit on your credit card.
Higher limits is a main, for people that aren't limit sensitive, those are the other reasons. But at a core level, it's not personally guaranteed and has higher limits.
And can you give, so if I raise $1 million, like what's
usually around 200,000 to 20%.
Okay.
So a big deal.
Yeah, because otherwise, like
you're going to be calling the bank every second, every Amazon Web Services bill you want to make.
Right. Yeah. Okay. Cool. All right. So there, Ramesh, thank you for your question. Next one is from Karina, who asked it on Facebook. Karina asks, how can Brex be for pre-funded groups? Between 3 of us, we need to print business cards and buy merch or cover coffee, business meetings, and we don't have $50,000 in the bank from a VC yet, they might not be your target customer.
Yeah, I think it's hard because when you're doing lending, you're always trying to measure two things: ability to pay and willingness to pay.
Got it.
And so while you might have the willingness, it's about the ability.
Got it.
So I think for what people would typically do in that scenario is first try to go to either a venture fund or accelerator, and then they give kind of the first money in.
Got it. Okay. Karina sorry, that's the answer. Okay, from LinkedIn, Derek Calburn. Derek, thanks for asking. Venture debt is exactly our stage. Low risk before round A to build inventory and demonstrate market without cash constraint. Can you recommend sources?
Yeah, I think that, look, I'm typically hesitant to recommend Silicon Valley Bank because we compete with them. SVP. Although I do think that they offer a good venture debt product.
Do you think of yourselves as venture debt? You say we compete with them?
We don't compete with them in venture debt, but we compete with them in other products.
Oh, sure.
But I'm, an honest guy, and I think that they offer a good venture debt product.
Okay. Anybody, maybe 2 or 3 others?
I think there's some. So Fifth Street Finance is a business development company that offers this a lot.
And they're based where?
They are based, I believe, in New York.
Okay, I thought so too.
And then there's a couple. Hercules is another version of Fifth Street Finance that I think is based in California, Hercules Capital. And then another good option would be there is a company called, I'll think of the name.
Okay,
but yeah.
That's fine. SVP is who comes to mind on that one. Okay, couple more questions. You okay for time?
Yeah, no, for sure.
So, all right. DJ Parker asked on LinkedIn, how did Brex get started? How did you get your first money credit facility to lend?
Yeah, so we raised a relatively large Series A, which allowed us, it was about...
Wait, but the started, where did it actually come from?
It started in Y Combinator with our founders who had the idea.
Right, and they were serial entrepreneurs from Brazil and
second-time entrepreneurs and friends.
Yep.
And so they basically raised a Y Combinator round, and then before we even launched, we had raised additional funds because we knew that as a lending product, we would run out of money if we weren't able to fund it.
Right.
Then we did a small sort of venture debt warehouse facility, actually with SVB.
Got it. Okay, cool. Thanks, DJ, for your question. Next, Rick Morgan on LinkedIn asked, Brex now has cards, a cash account. I'm sure it's looking into more products in the future. Is Brex slowly becoming a challenger bank for startups?
I think that we don't, we're not becoming a bank because that's a very specific regulated term.
Right, not getting a charter.
No, but I think that we continue to offer financial services products for, tech companies as well as other companies.
Got it. And you're U.S. only right now, correct?
We're U.S. only, that's right.
Okay. Well, you have an office in Vancouver, right?
We do, but we don't offer products to Canadians unless they have a U.S. entity.
Got it. Okay, cool. Thanks for your question, Rick. Next, Lionheart on LinkedIn asks...
Richard,
say again?
Richard the Lionheart.
Richard the Lionheart, yes, very good, sorry. In starting your startups, did you seek customers first or fundraised first? And what was your go-to-market strategy?
Yeah, I think we saw customers first. Yep. So we understood the need and made sure that there was a pain point before. And our go-to-market...
Wait, and is that where your pivot came from for Brex? Because you said that's not where you started.
Yeah, I think our pivot sort of came from there, and that was actually the second pivot. The first pivot was they started a virtual reality company, which is quite different. So it was multiple pivots, but I wasn't there for the first pivot. Okay. And then our go-to-market strategy was very much, it was a lot driven by my experience at SoFi, which was more consumer, I would say. So we were very focused on launch and doing a big splash. We combined it with outdoor advertising, huge press. We waited a while to announce our company, and so we announced a ton of things that got a lot of buzz right at once. So it was more of a consumer-oriented launch.
Got it. So you came out of stealth.
We came out of stealth, yeah.
Okay.
And that worked because even though our product is B2B, it kind of has a consumer-like decision process and sign-up flow.
Got it. Okay, cool. Thanks. Next, they keep pouring in. William, only one more after this. William asked on LinkedIn, William Reed, thanks for your question. With the BNP Paribas relationship, are you going to pursue a wholesale model for card issuing? Well, people might be asking questions, they're getting into too much detail.
Yeah, no, I mean, that's fine. I think that that is sort of I think that's a business development driven. Ideally, it's somewhat wholesale, though co-branded. So I would say it's important for us to have our brand out there as well. Yeah, right. But for me, the BNP relationship, which is something I worked on, probably one of my proudest moments here to get a bank like BNP Paribas,
that's awesome,
who is very large, international, French, to partner with a company that is less than 18 months at the time since its launch is not easy to do.
That's cool. Very, very cool. Okay, cool. Last question, one more from Lionheart, Richard Lionheart.
Thank you, Richard.
On LinkedIn, what lesson or lessons did you learn from your first startup that helped you do the other one better? What do you take away from SoFi that you bring to Brex?
Yeah, I mean, a lot of them are, I think, just when you can see the future of a successful business, you kind of know what problems you want to solve for. So certain ones around financial infrastructure, moving to NetSuite, getting audited early, a lot of those really tactical things that I knew were very painful, making sure your cap table's set up right.
By the way, on cap table, do you use a product like
We use Carta.
Carta.
We use Carta, which I actually highly recommend.
Yeah, I was going to say, all the Dreamit startups use Carta. It makes our life so much easier.
And so just getting all, I had interns.
Wait, NetSuite, Carta, DocuSign.
Yeah, I had teams of interns in the summer at SoFi cleaning up the cap table. I mean, it was a huge, it was like this, I called it the salt mines.
Right.
We had people going in, I mean, it was crazy. So I think that it's a lot of those things I learned. And then I think more broadly, I think you learn intuition around when to promote people internally and when to hire externally. That's one of the hardest things you deal with in an early stage company. And I think the only way you can really learn that is experience.
Got it. Okay, cool. Those are all our questions. It's 1:00 Eastern. It's been a full hour. Really appreciate your time.
Thank you.
Michael, it was
Thanks for
awesome.
having
Again,
me.
if you haven't checked out the Brex credit card and their cash account, check it out. It's great. We're a customer, all the major accelerators. It's a great benefit. Free for life. If you're interested in Dreamit, check out dreamit.com/apply if you have ideas for guests. Thanks for joining us today.
Thank you. Appreciate it.
Take care. Thanks.